Got Devinaehra, founder, chairperson and managing director, First Global, joining us on the show. What a pleasure it is to have you here with us on this very special occasion as we enter 2026 and multiple doubts linger around what to do and what to expect as far as the stock markets go. So let's not do a regular market show. Let's actually try and add a little bit of entertainment to it. I don't know how big buffs of Bollywood you are. I know Mr. Nilesh Shah is a big cricket buff, but we thought let's bring in a little bit of Bollywood twist to our conversation this morning. So Devna, first off, straight off the bat, all retail investors looking at their portfolios not growing at the same clip that they became accustomed to before 2025 have just one hope. And that hope is, mere FIIs aayenge. My question is, mere FIIs kab aayenge?
क्वेश्चन ही गलत है. So I mean, मैं तो यही बोलूँगी. So if we have to look at FIIs, if you look at just plot FIIs net buys and net sells versus the market, and you will see there is no correlation between the two. So I mean the sort of intent behind the question is that when the FIIs come back, then the market will go up, or if they exit, then the market goes down. That is simply not the case. So that, as I said, that's the wrong question. I mean, the direction of the market, if you want to know, the cause is not FIIs going in and out. So that's and this I'm talking the long-term history. And if you really want something from history, I will tell you FIIs started investing in the markets around 1994. And before that, foreign investors could not invest in India. So you would have said that this massive liquidity is coming from a source which didn't even exist earlier, so the market will go through the roof. But
Right.
What happened from 94 to 2003 is the only 9-year period in the market history when the net returns were zero. Sensex returns were zero for that period.
Right.
I mean, it went up and it went down. So I mean, there's no correlation, let alone causation. So that's not the right question to ask, I would say.
So Devina, there were conversations around the market valuation and overall some froth in the markets, till about a year back. Do you think with this correction that we've seen, at least in the indices, that sort of fear of froth and overhyped valuations has been arrested to some extent?
See, first of all, index level valuation, especially since most people look at PE, is not really worth looking at simply because the composition of the index has changed so much over the years. So if
Right.
I go back, a little over 2 decades, there were no banks or financials in the main indices. Now they are the highest weight. At one time, these indices were full of public sector PSUs. And then there came a time when people forgot that they were PSUs. But if you plot the sectoral PEs, they're actually not at extremes, and they have not been at extremes. So as far as the mainstream stocks are concerned, last year also 2024, most of the kind of froth was more in the small cap, micro cap rather
Right.
than in the large cap. So the large cap valuation for almost all industries were not at extreme ends. They're still not at extreme ends. And I do see an uptick in earnings coming up. So that is the other thing. The other thing which I would like to remind viewers is that sentiment is a contraindicator. Of late, I have seen most TV anchors or in other media, everyone is enumerating the risks. So that focus is more on risks, and that shows, and people are asking that should I stop my SIP, should I get out of the market?
Right.
So when those questions come, those anxieties come, and this is hard data, this is research studies done all over the world,
Sure.
not just India, US, but Portugal, Brazil, wherever the study is done, is that when people are asking these questions, the next period returns are above normal. When it appears that great returns are there for the taking, as was the case in the first 8 to 10 months of 2024, when everybody thought 30% compounding to kahin nahi gaya, so that is when the returns are below normal. So if you see the last samvat, you hardly got any return.
That's right.
And even now, when the indexes that do show some increase for this year, if you look at the median stock in, let us say, the NSE 500 or BSE 500, they are still down. There's still a considerable portion of the stocks which are down more than 20%, more than 30%, which is why even though the indexes have done reasonably, you can say, the portfolios are still showing a lot of red. So I'm sure a lot of your viewers will not see the index returns on their portfolios.
Right. So index returns on portfolios not coming through, but the SIP strategy must continue if that is what you're saying, Devina. I hear you loud and clear that these are times perhaps to continue with accumulation even if valuations are low. But coming to the
To
overall
the
market,
extent of your equity valuation, allocation, I must add that. Never
increase
have
your allocation.
100% of equity, but
Right.
whatever is your equity allocation, it makes sense to be invested.
So you were talking about India's fundamentals and the growth numbers. So let's bring up on that account the next sort of Bollywood meme for stock markets that we have. Devina, do you expect up ki bar 8% par? At least H1 tells us that we are clocking a run rate of 8%. Do you think that momentum can continue given the fact that we are now looking at hopefully better Q3 earnings results also after the GST cuts, which should have led to better consumption? Can we expect hopefully clocking and continuing with this 8% run rate and say up ki bar 8% par for FY26?
See, I mean, even now, if you look at the GDP, a lot of the heavy lifting is being done by government expenditure. Yes, private consumption is now going up. The low for private consumption was in 23-24, so it's been going up since then. When people discovered it only when the market started going down that there was a problem with consumption, but actually the low was in 23-24. So consumption is going up, which is why I said, that's part of the reason why you will see corporate earnings going up. So, and part of why consumption is going up is that the inflation is low. So
Right.
to some extent, I would say that the real GDP number is little bit overstated. And if you look at corporate earnings, they are really tied to nominal GDP, which not real GDP. Because and you actually calculate the nominal GDP and then use the inflation as a deflator.
Right.
Nominal GDP numbers have been actually quite low, and part of it, of course, as I said, is not just that the inflation has come down, but in certain products, the prices themselves have come down, which
Right.
almost never happens, which looks like a very good thing, except that when you remember that nearly 50% of India's population is dependent on agriculture, 46%, I think, is the number.
Yeah.
And when food prices go down, their incomes go down. So it is good for the urban consumer, not so good for the rural consumer when the low inflation is driven by food prices. So that's the other side of the equation. But even so, I had expected earnings to have an uptick in the second quarter, but that got delayed as soon as the GST changes were announced, because that obviously disrupted the market in the short term, even though it's good for the long term. So then as soon as that was announced, my kind of expectation shifted that the real uptick you will see Q3 onward. So that on the corporate earnings, yes, I mean, I still see good things. But part of that 8% number is an inflation anomaly. And I hope the other parts of the economy really go up and we are able to maintain that, because we need to maintain that if we want the Viksit Bharat by 2047. We need to have 8% plus growth on
Right.
a consistent basis.
What we are trying to arrive at is that there are going to be some critical moments in 2026 which could define potentially the trajectory of the markets. One, of course, being the fact that that Q3 earnings are going to be announced, followed by the budget speech, and then, of course, the India-US trade deal. Hopefully by March, at least, that is the indication which is coming through. So if Devinaehra, in case these were to come through, these three were to come through, can we expect a bull run in the Indian markets? And then again, going back to our Bollywood meme flavor of the day, can we sort of expect that, that the bulls right now, which are caged, are pretty much the Ranveer Singh of Dhurandhar, who are saying that घायल हूं इसीलिए घातक हूं. Once these three tick marks come through for the Indian retail investors, then there is no stopping the bulls?
Actually, I mean, you don't even really have it for bull markets. We look for triggers in hindsight, and exactly the same things can be used to explain either a market rise or a market fall. And risk is always something you didn't see coming. But as I said, earnings, I do expect an uptake, which means that the fees will start to look even more reasonable. On the budget, I don't know how much room there is for good news, because even last budget, I don't know how many people picked up on this, but if you looked at the personal tax estimates last budget, personal income tax was cut, but you'd be surprised that the collections on personal income tax were budgeted to grow by 14%. Whereas GST and corporate tax were supposed to grow by 10.5% in line with the nominal GDP estimate. Right now, we are not even at that nominal GDP. That's another matter. But I'm saying, why was the personal income tax supposed to grow when you were by more than all other taxes when you were cutting into personal income tax rate? And as I said at that time itself, that there might be regulators trying to curb excess speculation in capital markets, but the government budget is really banking on it because obviously the higher taxes were supposed to come from the capital market related taxes. And maybe, I have not looked at the recent data, but sometime back I had seen that that all that day trading, etc., the volumes are falling. So maybe,
Yes.
this year also, I'm not sure whether the personal income tax targets would be met as per the budget in beginning of the year. So
Right. Okay.
that's one question mark. So I don't know whether there's any room for any good news from the budget.
Right.
And the budget, I would like to really concentrate on on employment, education, health. That's
Right.
the not capital market is never my ask from the budget.
Absolutely. But of course, for job creation, potentially some additional schemes beyond the PLI for the manufacturing sector and for, as they call, the animal spirits of corporate sector to be unleashed. Devina, commodities have been on a wild run. Silver and gold prices have gone through the roof. So investors who have missed out on this gold and silver rally would be pretty much like Deepika Padukone style saying, "Ek chutki gold ki कीमत tum kya jano." Is this gold going to become all the more expensive in 2026? We know that silver demand, likely with the curbs that China is likely to introduce from the 1st of Jan, could sort of, continue with the silver story, touching some experts saying as high as 2,75,000 rupees or so a kg. But is this gold story also going to continue into 2026?
I would like to tell your viewers that the worst reason to invest in anything is the FOMO feeling. So because that always derails you, and this is statistical again. If you chase the sector or the asset class that has done well of late, systematically you will underperform. In our multi-asset products, whether it is global or India, we always have allocation to precious metals, but it's more like a single-digit allocation. So it should not be that 30% or 40% of your money is in things like this. Silver, of course, has an industrial story also. Gold, let me also remind your viewers that in dollar terms has been a more volatile asset than equities.
Right.
And I had some time back seen that there was a headline saying gold has not seen a rally like this since 1979. And if you go forward from 1979, gold made a high in 1980. That from 19 years later in 1999, it was down still 62% over
Right.
nearly 2 decades. It came down 62%. And the high of 1980 was not crossed till 2007, 27 years. And it was not an anomaly. The next high, again, it fell 40%.
Okay.
So the rupee chart of gold looks decent only because it is a rupee depreciation chart.
Oh, I see.
So
Right.
हमारी नानी दादी गलत नहीं थी सोना खरीदने में, because at that time gold was the only hard currency asset you could buy. You could
Right.
not buy anything else internationally. You could not invest in international markets. But now that is not the case. Now
Right.
you should get your proper global exposure and outside the US also, not just the US.
Right.
And use precious metals, but should not be a huge part of your asset allocation. That's it. That's what I would say. And also, a thumb rule I repeat often, that the easiest way to see where the froth is in the market is to see where all the new fund offerings are clustering, because
Right.
they always come when that theme has gone beyond maturity and is close to the peak. This is again data over 25, 30 years. You see anything, whether it is IT fund, pharma fund, defense fund, small cap fund, they all cluster when the theme is peaking.
Looking at the auto stocks, Mr. Shah, and those auto stocks, of course, which are also in the discretionary category, have returned tremendous investor dividends this year. In fact, Maruti Suzuki year to date is up about 50%. Mahindra & Mahindra is up about 20% or so. Devina, let me come to you with the same question. If investors looking for advice from you were to sort of take your word and bet on certain sectors for 2026, what would be your advice to them?
See, normally, I mean, we relook at our allocation every quarter from base zero. So I'm not sure what I'm telling you today will hold all through 2026.
Okay.
But I can tell you where we are overweight sectorally, and that is auto components. It is pharma and healthcare. And it is this year, 2025, where we have added through the year has been FMCG. So we talked about the consumption story a while back. There was a time last year when the inflation was so high. It was literally, I mean, when the dal and oil prices are high, it literally crowds out even toothpaste and shampoo from household budget. So that there has been a relief. So FMCG is definitely something. Banking, we're not overweight, but this year, through the year, we have added banking first in the PSU pack and later on and some others. I'm normally very underweight banking, but this has been the turnaround year for banking. IT might be the kind of dark horse. It has been a pretty bad performer for 2025 and in fact for some time before that also. So just as banking for the 5 years prior to 2025 was a huge underperformer every year, barring one exceptional year, which was 2022. So something like that has happened to IT, and that might be the thing that changes in 2026. So broadly, otherwise it is on the stock picking. So, I mean, we have things which are good in capital goods, things which are good in chemicals. We've added some oil marketing companies, though we're not overweight there, but that's broadly the pattern.
All right. Well, on that note, let me thank you both, Devinaehra, Nilesh Shah. What a pleasure having you here with us on this market playbook for 2026. Well, if I can just quickly recap the advice which is coming from you, consumer discretionary stocks should be in focus, and look at the mid cap and the large cap stocks. That is a word coming in from Nilesh Shah. Devinaehra arguing that it could potentially also be an opportunity to dip into the FMCG space, and potentially the dark horse in 2026 could be the mostly undercut IT space, which could emerge as the dark horse. Well, on that note, Devina and Nilesh Shah, thank you so much for your time. It's been a pleasure having you here with us on News9 through the year, and I wish you both and from all of us here at News9 a very happy and prosperous 2026. Thank you so much for your time.